All right. Okay, awesome. Welcome everyone to the Investing Club June class. The markets, let me just mute people. Hold on one second. Okay. Okay, the markets have been rough to say the least. So today we'll really talk about, so what should we be doing? Should we be considering investing? All these questions that I'm getting asked personally, I'm thinking about, the media is writing about, and I'm sure it's on most people's mind. Okay, so how to survive a bear market. I think that's part of the theme of today. So okay, the agenda of what to expect in the next hour. Okay, so investing in a bear market, what should we expect? What are the opportunities? More importantly, should we just run from the bear? Money sandwich. So, we've been building out over time. We have the market indexes, we have the ETFs with the Investing Club portfolio, and now starting to get a little bit into some stocks. Not that we're ready to buy individual stocks, but just start to share a framework around that that's mostly going to be focused on dividend stocks with a little bit on REITs, real estate investment trusts. We'll take a look at the Investing Club portfolio, and then also I have an update on the boot camp, so I'll share that too. Okay, so disclaimer, the content of the Stock Market Investing Club and WhatsApp group for educational purposes only. I'm merely citing my own personal opinion. I'm not a licensed financial advisor, and this class is not intended to be used as a complete source of information on any particular company or investing vehicle. Every investment decision is your decision and your responsibility. Always research your investments and consult with a registered investment or pension advisor. All stocks and investments mentioned in the course are merely being used for illustrative purposes and are not a recommendation to buy or sell the securities. Any individual who chooses to invest money should do so with caution. Investing carries a high degree of risk. You may lose some or all of the money that's invested. I'm not responsible for your success or failure. Do not invest money that you can't afford to lose or rely upon for your cost of living. Okay. So I think as of yesterday, we sort of flirted with it a bit a week or two ago. The S&P has entered into a bear market, which means it's down 20% from its high. The Nasdaq has been in a bear market now for a bit, and there's talk about recession could be coming, stagflation. All of these different things are being thrown around. So I mean, people, it makes sense. They're asking me just a very basic question. If we think the stock market is going to get worse, which I think there's quite a bit of indication that it still could get worse, there's many unknowns that still need to be resolved, or drops like 50%, like, in 2008, it dropped, I think, maybe 54% from top to low, or it takes years to recover. All of these nightmare scenarios that maybe we don't even want to say aloud, and this dream of the stock market helping us is that's this cloud in the back of our mind. So should we still be in the market? Should we just sell everything? Should we get out partially to sort of hedge our bets? Should we be adding more? Or can we even fundamentally trust the market? You've heard me say a million times, the market goes up 71% of the time. So, why aren't we seeing it? Don't worry, we're going to get to that. So these questions we want to answer, and that's what we're going to do tonight. So what I want to do, and I've shared a little bit, but I don't think I've actually shared with anyone the full kind of details around this. So how I've done my gains and losses during the Great Recession, which I think all of you are aware of, that I lost 75% of my savings during the COVID crash, and also the China stock market crash, which happened in 2015. So the 2007, 2008 crash, Lehman Brothers went out of business. So with that one, the financial crisis, Great Recession, whatever you want to call it, the way that was when I was really getting into the market. And at that time, I was in business school as well. And I remember in business school, we're talking about banks, we're talking about things like that. I really took money that Keiko and I had saved, and we really put it primarily into the banking sector, into one or two stocks and a few others. So the idea of buying indexes, diversifying, all of the stuff that we are hammering in to do, that was totally approach that just was not what was going on. I also went all in. So, we've been hammering around the idea of dollar cost averaging. For anyone that's not so familiar, that means every month or every quarter, whatever you're comfortable with, you're consistently putting money into the market. You're not throwing it all in at once. Basically, lump sum investing is I'm taking everything that I have, I'm just putting it in all at once. And also I sold at the bottom. It's going down, it's going down. Is there going to be any stop to it? No understanding of technical fundamental analysis, just sort of, I don't know where this is going to go, and it's just losing money all the time. So as a result, we did very poorly. There were incredible learnings that came out of that. And because in our investing journey, we obviously had not accumulated that much money at that point, those lessons were expensive, but they taught us so much because you don't want to repeat it. But the biggest mistake that I would say is that because we got burned so badly, we didn't actually start investing again for about 3 years. And when that market hits the bottom, as we're going to see, the returns when it builds back up are massive. So not being in it during the period where it starts to recover, that was actually, I would say, the biggest mistake of basically just being like, I give up. I think the market's up something like, I need to look, but it's like up 1,000% since 2008. I mean, it's just, the market goes up, goes down, but being in it is key. So in 2015, the Chinese stock market crashed and had an effect on the US market as well. It brought down the S&P. Let me just mute.
Please.
Hold on. Okay, so in 2015, there was a Chinese stock market crash, brought down the S&P, brought down the US market. At that point, I was I'd learned as much as I could. I was really into it. I didn't sell at that time. And I added a bit here or there. It was a bit random. I didn't have the same knowledge that I've got now about, okay, let's see stability in the market. Let's see stages. Let's look at RSI, all of those things. So just sort of like, okay, I was buying a little bit on the way down, got scared, stopped it a little bit, bought it. But as a result, we made money from the crash. It recovered. It took about 3 months, but then that money that we were buying when it was going down, it obviously, that made money. So that was our first success from a crash. And then there's COVID. By this point, I thought I was a brilliant investor. I had an inkling that the market, I thought was, it had done well for so long that there was a chance that there was going to be a pullback. I obviously did not know the severity of COVID, but in February of 2020, before COVID hit, I actually sold a lot of stock that I've been holding for a long time. So when it started to go down, I'm like, you know what? It's I had all these thoughts and I'm so on top of it. And I also shorted the market. So, there's like QQQ, there's SQQQ, that when QQQ goes down, SQQQ goes up. So I started to buy that and I'm like, oh, as the market's going down, the worse it gets, the more money I'm making. The challenge with that was that the market started to rally. Basically, the Fed came in, they gave a huge amount of stimulus, like $1 trillion. The market turned. At that time, I was still shorting the market because from my perspective, it was like, COVID, this was like a month into COVID, and COVID was just, who knew how it would be contained? The thought from my perspective was it's going to be very hard for them to actually contain the fallout from this. And okay, they're putting money into the economy, but like, there's no way that all of a sudden everything's fine. The stock market has such a habit of surprising everyone. No matter what you think it's going to do, it often does very differently. That's why almost no one beats the market. So I thought I was so smart. The market started to rally. And then I had the issue, which I know a lot of people are facing now as well, where when you think there was a bottom and you missed that bottom and you didn't put money in, you think, I don't want to put money in now because I want it to go back to the bottom. And then it comes and goes back. And this game you play where like, I'm going to wait, or I think it's going to go down. Instead of putting money in consistently, it was really trying to just time the market. Then after a bit, I adjusted. I started DCAing back in, but I definitely, some of that bottom that I could have gone, I missed because I thought it's just going to get worse. Trying to outsmart the market essentially. In the end, from taking the money out before and then putting it back in, definitely the gains were nice, but being totally transparent, I would have gained more if I simply had my holdings and I just kept them in and I added to them as it was going down. The pullback right now is definitely longer lasting than COVID one was, and there's more questions. This is, there's a question of how long it will last, but from these things, from really losing a lot of money, from making money, and then from sort of doing it in between and realizing the more games you play, usually the less you win. We just hear it. This is from the Jack Bogle, the creator of Vanguard. He made mutual low cost ETF. So don't let changes in the market, even the big ones like the financial crisis, change your mind. Never be in or out of the market like binary. I'm all in, I'm all out. Stay the course. From Buffett, money is made in investing by owning good companies for long periods of time. That's what people should do with stocks, ETFs, I would imagine, indexes too. I tell investors, don't watch the market closely during a period of wild market fluctuations. It can mess with your emotions. We don't need to be paying attention to it that often. Again, our idea of dollar cost averaging in, that's an action that we can do once a month, once a quarter, things like that. There's an example I think I shared before, which is like if you're on a diet and you look at the scale daily or multiple times a day, I don't think anyone would say that's helpful. If you're totally fixated on the market, it's also usually not good because it can play games with your emotions. The last point, which I think is also an interesting one, where we try to anticipate and say, okay, I'm going to take it out, but then I'm going to put it back in. By the time news looks better, the market reacts instantly. The Fed is giving their announcement today, I think actually in like 30 minutes or something, about how much they're going to raise interest rates. That will then be baked into the market right away. Often, I shared on the Investing Club, some of the biggest gains in the market come right after the biggest drops. It's a yo-yo. So often, if you miss a recovery, there's a good chance it's going to make it harder to hit your financial goals. And that issue I had with COVID, where it's like, I missed the bottom, I missed the bounce. Now I don't want to go in now because maybe it's going to go back down. It's those games generally do not serve the vast majority of people. To say everyone's welcome to do what they want, but I think it's something worth considering. So now, just to get practical, the market has always recovered. We know this. Not every individual stock has. That's also why we keep pushing, especially in volatile times, to go to indexes. And we're doing a little bit into ETFs of sectors and things like that. But still, my updates are mostly still about indexes, and it's by nature of the fact that the market is still volatile, and those usually are just less, and they always recover over time. So the biggest advantage or disadvantage is your time horizon. We know this kind of thing, but again, if you need that money soon, if you need to buy a house, if you need to retire, that's where you get into trouble. If you have time to let the money be in the market, it's much less of an issue. But what I want to do is we keep talking about the strategy of DCAing into the market, buying the dip. I want to run a nightmare scenario. Let's say that similar to 2008, the market drops 50%. It doesn't recover for 2 years. What should we actually do? Let's brace ourselves for if it's a situation like that. I'm not saying it is, but again, let's see what the opportunity is. So I have something that I'll share with everyone after this. It's a bear market upside calculator. So to figure out actually what we can do. So let me pull this up here. Okay, so I'm going to zoom in a little bit. Like most of the charts I try to give us, it really just requires you to input one or two things. So what is this? Okay, we're going to assume that we're in a bear market. And that bear market, there's a few inputs. Let me start with these. The bear market's going to last for 24 months. On average, the average bear market lasts, I think, between a year and a half. Some are longer, some are shorter. Let's just put a scenario that I think no one would be happy about. The bear market drops a staggering 50%. We could make it lower, but I think that's a scenario where I think the government and a lot of people would jump in to try and save it. So I think for all of us, you might have a lump sum that's already in the market. And then the idea is you want to be DCAing in consistently. The strategy throughout has always been, rather than put a lot of money into the market, even if you have a big chunk right now, put it slowly into the market over time. We don't know what's going to happen. So what I'm going to do here is I'm going to say, this is where you will input your own numbers. I'm going to say I have $10,000 in the market already, lump sum, right? And over the next 24 months or 2 years, I'm going to put in another 10,000. So each year I'm going to put in 5,000. I could change this number. I could change it to 10,000. It will change the inputs. I can change this to 15,000, whatever. So I'm just giving a scenario here. I do it for 1,000 as well, 10,000, and this is going to be 5,000. Okay, so what that means is if you're investing 5,000 during the year, each month you're putting in $417, 5,000 divided by 12. as we saw, 24 months and 50%. Okay, so let's see what happens to the lump sum, because I have a lump sum already in the market. I've been investing for a while. It's not like I just have all this money on the side waiting. So what we're going to assume with this is that the lump sum is not going to make any money. It's going to be in the market, and it's just going to do as the market does. So in this calendar, it's month 0. The amount, there's been no pullback in the market, so it's still worth $10,000. Month 1, the market's gone down 5%, so that 10,000 is now worth 9,500. Okay, it's going down over time. It goes down 10,000, 15. Of course, it's not perfectly linear, but it's okay for our purposes. And then when it really gets down to the bottom here at 50%, we're going to assume that it actually hangs out there for a while. That's not a quick recovery. If it's a quick recovery, even better. But let's just assume it's like no one believes in the market. It takes a long time. So it goes from 50%, 50, 45, 50, 45, and then it starts to go back up. So by the end of it, you can see that 10,000 is growing back up, and it finally goes back to the original amount. I'm saying after 2 years, it goes up 2%. So I made $200. Okay, that's the assumption. That lump sum is in there. Now, with the money that most of us have at our disposal, whether it's you have still some money that's not invested, you have a salary that you can take money each month, just like your pension's doing and putting in, what will actually happen when we DCA into the market? So here we go. It's the exact same scenario where the first month, the market's flat. Then the market goes down 5%. So the assumption is every month, we're putting in this $417. Again, we can change this based on whatever we put here. The thing that's interesting to note, and we've talked about this, but I just want to bring it up again, is as the market goes down, it dropped 5%. When you go back to the previous level was, the increase is more than 5%. The simplest example I'll say is this. When the market, let's have a stock and it's $100, it drops 50%. So it goes down to $50. If I'm buying it at $50, when it goes back up to 100, that's 100% gain. So the gains are outsized. You can make extraordinary gains when the market is down. So basically running this scenario, and I'll give it to you guys so you can do it. Each month, the market goes down another 5%, and each month I'm putting in another $417. This is at the end of the time, how much it generates. As you can see here, it's when it's down 50%, it actually makes a full $417 back. When you aggregate this out, your total DCA gain over the time is a little over $4,000. So this is over, you put in 10,000 in total for over 2 years. So it's a 44% gain. This is when people heard about COVID and they're like, look, I want to make gains like, NASDAQ was up 40%. When the market's down, you have actually the opportunity to make very similar types of gains to that. And the worse it gets, the higher the gains become. When you add together the amount you invest in the lump sum and the DCA together, because that's the reality, you had 10,000 and you had 10,000 here, 5,000 each year. Then those returns are 22% over a 2-year period. So over a 1-year period, you actually made more than the S&P returns on average at 10%. Many people are surprised when they see this, that the DCA amount can make this much difference. And look, I'm going to be transparent. If your lump sum is much bigger and the DCA is a small amount, it's not going to make up as much of a difference. But really, the main takeaway from this is that if you're able to consistently put into the market, even with it taking 2 years to recover, the lower it goes, the more money you are going to get. So that's how I am playing the market. It flips things, and I know that it's uncomfortable for a lot of people for the market to go down, but the more it goes down, unless you fundamentally believe that the stock market and everything is going to collapse, which I think is a bit of an extreme statement, you are making, instead of the market going up and you're making the gains, you make it from it going down, and it still comes to, and it's sort of like, there was a bear market, but over the bear market 2 years, I actually made the same, just about over the same 10% return that I normally would. So the lower the market goes, the more upside DCA has. And if it sits at lows for months and the market just like waits there, also that higher upside, it down 40%, 45, 50. When it comes back, it's incredible what that can do. And it's also not binary. So it's not like, hey, I either have to go in every month or I have to put in a certain amount. Especially for people that are starting out, putting in a little bit is fine. With the China crash, I was not systematic. I was just like, I should be buying the dip. It's down, things like that. And that was easier because it really was only down for about 3 months. But having this mindset of like, okay, the more it goes down, the more the upside will be. And if you're not comfortable, you go slowly. This is a suggested strategy. Everyone needs to do what they are comfortable with, but it doesn't have to be either or. You can try it. Usually what I'm doing with the investing club is I'm calling out, this is, I see stability here. It's an interesting time to put some money into the market, because I'm not trying to put in when it's in mid falling knife or when it's already is shot back up and we're almost near a resistance level. So that helps us to sort of hone in a little bit. And then the last aspect of this, then I'll open up to questions because I've just been talking and talking, is what's on the other side of a recession. This is also amazing. There are periods of economic expansion. So the last few recessions we've had, the last 30 years, give or take, we had the Gulf War, we had that, there was oil prices, with what was going on there. Following that, there was a recession, and then there was 10 years of expansion. So we talk about this idea of the markets going up 71% of the time. It usually happens in chunks. You have a period where it goes down, there still is opportunity, and then you have a long stretches where the market goes up. After that, went from 91 to the bubble bursting. That had 7 years of expansion after the recession up until the Great Recession. And the Great Recession basically was, I think it was like I think it might have been the longest recorded one. It was 12 years until COVID. Now COVID was only was a short recession. Now we're into the next one here. But what you can see is that basically, historically, after recessions, in many cases, you have prolonged periods of growth and great market returns. And that's, again, where that 70, the market's going up 70% of the time, you see it play out. So the idea, DCA into make money in the short term, and the next 2 years, you're positioned also for long-term growth. And what I will say, and then I'll open this up to questions, is it's very interesting for me as someone that is teaching courses on the stock market. If I started teaching this course, let's say in April of 2020, and the market was just, was up for like a year and a half straight, it'd be a very different experience than, we started the investing club in like January, February. And a lot of people that are here, we've been working together maybe a little bit longer than that. There's something that I actually appreciate about that, the fact that the market, the challenges that are going in the market, again, they happen once every half a decade. And to me, although I know it's not comfortable, if you're able to stick with the market, and doesn't mean you have to be actively investing, you do what you're comfortable with. Once you're able to get through this period and then see the ramp up back, it will fast track your ability to invest with confidence, because the crash is the hardest thing about investing. Keeping your emotions in check. Emotional regulation is actually really what keeps people out, because they're looking and they're scared and they don't know, and that's natural. That I don't think things are coincidence. I think it was chosen for whatever reason. This was a time that I would be sharing this information during a difficult time, and that everyone that's in these courses also, we're learning these lessons together for a reason, to actually prepare you for the future, and so you can handle stuff and basically be like, okay, I've seen bad stuff and I got through it, because once you do that, most people cannot. Okay, so I'm going to move on, but let me just ask if you have any questions on anything that I covered. Happy to take questions.
I had a question.
Sure.
Could you go back to the slide with the calculator, please?
Yeah, sure. And I'll send this to you guys also, so you can play with it.
Thank you. So I did not understand the lump sum investment. Seems fairly clear, right? We're losing money every month. I didn't understand the DCA investment, how if we're losing 5%, how we're gaining 5% back.
Okay, good question.
The market is going down 5. How is it?
Okay, so what I did with this, and you can also look at the cells, what this is representing, because I was trying to figure out a way to like organize it so you can see the results, but the way that what this is saying is that the money, so the amounts here are laid out in a different way than the lump sum. The money that you invested month one, the 417, it went down -5%, and then it went up 5.3%. This is after the 2 years. That first month, that initial 417 would have gained $21. Here, month two, this is you put something in, you put $417 in, it went down 10%. And after it recovers, it went up 11%. So this is showing the gain, the 11% gain. That's why when you look here, it went down 50%. You see the full $417 gain. So it's not laid out in terms of, hey, I get that it's confusing. This is, hey, I see the money's going down. This, it's actually showing what the return would be after the money recovers. That's why it's so valuable to put the money in when it's down 50%. You can just see as an example.
So you're saying that the gain of month one, it's actually the month one amount, which was $417 that you put in, went down 5%, but then 2 years later, you
Yes.
gained 5% on that money that you lost 5% on 2 years before.
Yes, you gain 5.3% because when it goes down 5%, for it to recover, it's a slightly higher number. As I mentioned about the example here, where something goes down 50%, the recovery is 100%, so the gain is higher. That's why it's not down to zero. It's you get that extra gain.
Okay.
And I'll send it to you. And if the stuff is not clear or whatever, maybe what I can do is when I share this, I'll maybe share a few notes so you can see more. But it's but ultimately the calculations should be correct. If they're not, let me know. But I think that you'll find that when you see the logic that the numbers are there and they're what they should be. Any maybe another question or two, and then I'll keep rolling. Hey.
Yeah, I got a quick question.
Sure.
In terms of if we wanted to try and do it with the actual money that we've invested, when would you say that the start of the bear market occurred? Is it back in January at the high?
Oh, you're saying so that's also another thing. Like with this, the idea was to make it flexible. So you can go in here, you can change and say month one, I'm starting now, and the market's already down 30%, and you can change the numbers and put them in based on like when you want to begin the scenario. Is that what you're asking, or is it something else?
Yeah. So, if you've got month zero, I mean, that's in terms of the money that we invested, it's like back in January, right? But, you could say now that it's already down to 20% or something. So you can say month zero is 20% and we've got our $10,000 in or whatever. And then it's going to go down to 50 over the next few months.
Yeah. So you can basically modify and move some of these up. I was working on a way to actually do it where you could automatically do it, like choose which month you want to start at the percentage. It's not quite there yet. If there's any Excel wizards that want to help me take to the next step, but regardless, you can still manually put in and be like, okay, I'm going to start at -20.
Great, thank you.
Sure. Okay.
Can I just ask you something about something you said before? You said you bought SQQQ. And I have two questions about that. One is, do you like buy and sell it every day? Because sometimes those funds like rebalance every day, and I'm really scared of that. And how much of a percentage of your portfolio would you put into one of those inverse funds?
So I want to caveat this by saying, I did that before. I had some gains, but overall, it's not a strategy that I recommend doing for the same reason that the market goes up more than it goes down. What I actually, okay, I don't want to get too much into a side thing on this because I'm not recommending doing it, but okay. So these funds, there's a fee to having them, these inverse ones that let you short the market. So that means that if you hold it for a long period of time, the value of it goes down. So usually you're not holding them for that long. I maybe held it for 2 weeks or something like that. It's not like such an extreme period of time, but that's something, as you're mentioning, to be aware of. What I actually tried to do exactly was I didn't take all of my money out. I still had some money in the market. And what I tried to do is I tried to lock that money in place. So what I mean by that, and again, this adds a layer of complexity and I'm not recommending it. The SQQQ, as I mentioned, when QQQ goes down, SQQQ goes up, but it has 3 times the return. So that's kind of risky. But what that meant is that if I had $100 of QQQ and I wanted to make sure it wouldn't lose value, if I bought $33 of SQQQ, because it's 3 times the leverage, then it would even out. What I tried to do a little bit was I just wanted to lock my portfolio in place. So I don't remember the exact amount I had in my portfolio, but I was doing it at a point where I was sort of saying, I shorted it, and then I said, I just want to lock in my gains. So as much money as I had in the market, I had also the inverse of SQQ. So if the market went up or went down, it would basically just stay level.
So you had like half your money in SQQQ?
I took a lot of money out. So I had a portion of it left.
Oh, okay.
Let's say I had 25% of my money left. And then what I did is that I bought a third of that 25% in SQQQ, because that is triple leverage. So it has the same value as that 25%. And then if the market went up, SQQ went down. So my value was level. If the market went down, SQQ went up. So again, the market was level. So I did it to basically lock my account to not lose money.
Okay.
I can share maybe more on the Discord, but it's not something that I really am recommending for people to do. And it's one of those things. I thought that the market's going down. It's so easy. You have to be right twice. You need to be right. And this is actually it was a good learning for me. I need to be right when I chose that the market was going down. So I was right but I wasn't right about when the market was going to rebound. So, if you're holding something for a long time and you're holding it's going down and down, down, but it goes up eventually, you just need to be right eventually. If you're shorting the market, you need to choose when to short it, and you need to go down, and then you need to choose when to sell it. So being right twice is you're less likely to be right. Okay. I've been in crypto for a while. I'm slowly continuing to accumulate. It's the same basic philosophy as with the stock market. There were a few things that happened in crypto. Basically, one of the exchanges, Celsius, had an issue with it. People couldn't take money out. There was also another a token called Luna that had an issue that caused maybe a crash, maybe about a month or two.
I mean, these are huge the incidents that have all happened in a string of in the span of a month. And it just seems so nutty right now.
Yes, it seems nutty. Do I think crypto is out? I personally don't think that it's out. I think it's crypto, it's more volatile. So this news has been bad, and it's been on the back of all of the bad macroeconomic news about interest and all that stuff. So Wall Street essentially is trading crypto a little bit like a tech stock, like NASDAQ. As NASDAQ sells off, crypto is as well, and crypto's had some more bad news, so it's sold out even more, and by nature, it's more volatile. Do I think that Bitcoin will never reach the 69,000 high? I think that it will, and more. But crypto bear markets, the one between 2018 and 2020, 2-year bear market. So really with crypto, what I would say is there's a reason it's only 5% of the money sandwich. It's the smallest part because it is very volatile, and it's the last part. I think that if you are slowly accumulating with a long time horizon, that to me, that's something that's worth considering. But it depends on your risk tolerance. It depends when you need the money back. I think that all markets will recover. I think crypto will as well. I think we're going to still see very, very amazing things from it. It's still, I believe, the best performing asset class in the last 10 years. What I recommend, if you're new to crypto, would I recommend you touching it right now? I'd say that let's wait for the market to stabilize a little bit more, because it's definitely in falling knife mode. But if people were interested in crypto, 30,000, 40,000, 50,000, having a 20,000 to me just sounds like that's a better price than it was then. All right.
Malcolm?
Yeah.
Another question regarding we've been saying, especially in the bear market, we're going more into the indexes because they're pretty safe. Eventually, someday they will recover. I mean, could you say the same thing then for some of these dividend ETFs, especially if they're based off like the SPY-D, like it's pretty much based off those dividends within the SPY, within the SPY. And so I mean, and if one of the stocks within that ETF were to crash, they'll replace it with another dividend. So I mean, would you say that's also kind of a safe DCA and just don't set stops on that one, just kind of let it ride, and eventually we'll recover, things like that?
So for me, for ETFs that I've held for a while and that have made me money, I'm less inclined to initially put stops on them because I'm a little bit more comfortable with how they've moved and they've gone up and they've gone down, and I've seen them generate positive returns. For ones that are new in the current market environment, I think that the market could continue to turn, it could go down, things like that. There's no reason to be holding, specific ETFs like that. If they are going down, again, it depends. I agree. Dividend ETFs are fairly safe. So I guess here's how I would think a little bit about it, right? If you're holding one specific sector, you're more at risk than if you're holding many sectors. That's what the S&P is. So if you have a dividend ETF, which I'm sure it is the case, where it has dividends in industrials, it has dividends in commodities, it has dividends in healthcare, it has a mix of those companies, it's like a little mini S&P. I think in that case, it makes more sense. If you have a focused one where it's like dividends just in, let's just say tech, then I think you're like, okay, well, tech is selling off more. So it's just looking inside the portfolio to just get a sense of how broad it is. But I think
those are diversified also.
Yeah.
Yeah. Thanks.
Sure.
I have a question about what you just were talking about.
Sure.
Like in general, but also the dividend ETFs.
Yeah.
So one is, I mean, when you sell something, you have to pay the tax. So you need the money to pay the tax. And it also means that the money you use to pay the tax, you can invest elsewhere. So how much of a concern is that? And my other question is anything really, if you have a stop on something, is it still unsafe? Meaning, like, let's say you see oil's going up and you put a lot of money into it, but you have a stop. Is that a problem?
Okay, so your first question about taxation, you're only taxed on gains that you make. So if your money went up, if you're in Israel and you sell it, you're going to get 25% taken out. So if you lose money, you're not going to pay tax on it. So the idea of, hey, you don't have that money to still invest, by definition, you've made some money, so you should have it. Am I understanding what you're mentioning, or is it a different case you're talking about?
Yeah, I guess that's true. I just always hear people are so hesitant to generate any sort of taxable event. And I used to think, like, you're going to have to pay the tax eventually. If you ever sell something, you're going to have to pay the tax on all the profit anyway. But still, people are really hesitant. So I'm always trying to understand that.
The one thing that I would say is that if you're within 10 years of Aliyah and you have a brokerage account abroad, you file taxes the following calendar year. So that way, I'm selling something, I'm making money. All of that money gets rolled into whatever I want to invest in until I pay taxes the following year. So you have a lot of flexibility. If you have an Israeli account, the nature of how it is they will take out that 25% gain right away. So I would say that it's definitely less of a factor if you have an international account, because then, okay, it's a taxable account. But again, what I sold in COVID of February of 2022, I only paid the tax on that money in June or something of 2021. So that it's less, if that's the case, I think you don't need to be as worried about it. Okay. Remind me the second question you had.
Yeah, the second question was about a stop. Is anything unsafe if you have a stop?
Okay, so I think I'm trying to remember who brought this up recently. The thing you have to be aware about a stop is that sometimes there can be bad news overnight or whatever, and the market will drop down below the stop price. Like, I think we've watched a bit like Netflix.
Oh, yeah,
many
I
of these
remember
companies.
this.
So it will still buy it will still sell the stock at the market open price. Okay, let's just do a very simple example. I buy a stock, it's $10. I put a stop at $8. All of a sudden, earnings come out and it drops to $6 at after market. So the market's not open for me to do the stop. When the market opens, it's going to sell it at $6. So that is a risk that you face. It's not so common, but that is the one shortfall of a stop.
Okay.
But what I will say is that often when things have big drops, they tend to continue dropping faster than they pick up. So it still can make sense. It's not 100% that even selling at that lower price is still better than holding it until it goes to $4.
Okay, thanks.
Maybe I'll take one or two more. Debbie, I think you're muted. I think
Yeah,
you are.
okay.
Okay.
I apologize if you answered this previously because I missed the last two meetings, but I'm just curious why you wouldn't put a stop on the SPY or QQQ if it can help prevent losses.
I think as a rule, what we're trying to do is accumulate. So we're trying to accumulate the things that go up the most and that are the least volatile. There are definitely, and I've gotten this question from people, should I have put on stops and things like that? My perspective is we want to be putting money into the market on a regular basis. We can't predict exactly what's going to happen. Through these indicators, we get a better sense, but the market changes. There's news that comes out all the time. So the idea of buying and selling frequently, a lot of your holdings, your main core holdings, there are some tax ramifications, but it's just sort of like then you start to be playing too many games. You know, you sell it, then all of a sudden the market 2 days later goes back up and you're like, oh, now do I buy it? But now it's above what I sold it for. So I really, in general, and I want to make this so it doesn't complicate things for people, because people in general don't want to deal with stops, looking at positions, buying and selling regularly, which we don't want to be doing. Market indexes, I'm putting money into them regularly as they go down. Also, you don't have to. I'm continuing to accumulate slowly. If it feels bad or worse, maybe I turn down the speed or the amount that I'm doing it. For ETFs and new ones that I'm going into that have not proven they can make me money and they are more volatile and typically don't perform as well as the market, especially now in the current environment, I don't want to be holding them when they're going down. There's just no real benefit to doing it unless I really believe in it. Like if I work in the healthcare sector and I just know that what's going to happen is going to really push up the industry. But if I'm buying 3 or 4 different ETFs, that's also a way to protect yourself. You choose 3 or 4 industries you like, you buy them, you have stops. Maybe 2 get stopped out. The other 2 continue to grow, and then you're not holding those ones that just went down and down.
Mm-hmm. Okay, great. Thank you.
Sure. All right. Okay. So I think that's okay. Let's thank you everyone for this, and I hope this. I'll send out that the Excel document so you guys can run your own scenarios and see what's going on. I would say that if the market goes down 50%, I'm not saying it will, I don't think anyone's going to be smiling about it, but being able to get through that and get some of those gains, it will change your investing game for life. Having gone through 2008, making the mistakes, and putting in and just sticking within the China one and COVID playing games, this is what I've seen. And this is, you ask any of the pros, this kind of approach, not easy, but it's fairly simple and should serve you the best over time.
Great.